Hello guys, welcome back. Hope you're having a nice weekend. In this video we are going to talk about the possibility of a recession, which is I think that a lot of us fear, of course. And since the stock market has been completely devastated lately, we're having even more and more fear about a potential recession that is upcoming in the next few months. So in this video we're going to use some economic indicators, some financial indicators that we can get from the Department of Treasury and other sources, really, official sources that is. And we are going to talk about how this can potentially tell us whether there's going to be a recession in the US or not. So let's start off here. And before we do all this analysis, I wanted to tell you a little bit of a generic thing about a recession. The fact of a recession happening or not has a lot to do with how the government responds. And a lot of the policies of the government can actually increase the possibility of a recession. For example, if the government actually cancels debt, which is something, student debt that is, which is something that has been discussed lately, this will be devastating for the economy, and so it will continue bringing all the negativity eventually. It may have a little bit of an upside initially, but later on, it's definitely going to devastate the overall economy. So what the government does matters a lot. Their policies matter a lot, and for the most part, this is what has brought us in this situation in the first place. Really, the fact that they printed tons of money was the most important reason why we're getting this kind of an economy today with a lot of inflationary pressure. So let's see what is happening right now in terms of the yield curve. Now, you may not be aware of what a yield curve is. A yield curve is basically the relationship between short-term debt obligations and long-term debt obligations, and that's from the US. So what does that mean? Now remember that the US can issue bonds, for example, notes that you can actually buy, and in this case, when you do that, the US is actually owing you money, and they are paying back some interest to you. That's the yield that you are getting out of holding a government bond, for example. And so, depending on how long you are willing to keep that debt going for the US, and you becoming the creditor, you are getting more of an interest rate because you have more risk if it's a lengthier term. So if you are willing to hold a bond for 10 years, you're gonna get a higher interest than a bond for 1 month. And as you will see here, the actual rates are denoted in this little table here. So for example, in the 1st of June 2022, a few days ago, buying a bond, a US bond, would yield 0.77% of an interest here for you, after which month the bond would expire and you will get your capital back plus the yield. Now, if we're talking about a 10-year bond here, we are looking at almost 3% of a yield. And typically, as you can understand, you are getting a higher yield as you are getting a lengthier term here. That makes a lot of sense because, again, you have more risk if you are getting a lengthier term bond here. Now, there are situations in which you are seeing that shorter term bonds here actually have higher interest rates than the longer term ones. This doesn't happen often, but when it happens, we're talking about an inverted yield. Now, we don't really have the chart here, but if you actually plotted this, you would see the situation with the shorter term having a sort of like a higher peak than the longer one, which means that the yield has inverted. And there is a situation of that sort that actually just happened yesterday. You will see here, if you take a look, the 5-year. Let's take a look at this one. The 5-year effective yield is 3.25% and the 30-year is 3.2%. Now, typically speaking, the economists tend to look more like between the 2-month and the 10-year one, but that's not necessarily the case for predicting a potential downturn. So we're looking here at a case where the 5-year bond will yield a higher interest rate than the 30-year one. So what does that mean, practically speaking? This means that owning a 5-year bond has more risk than owning a 30-year bond. And so because it has more risk, it yields a higher interest rate. And why would it have more risk? It would have more risk if you are expected to have a sort of like a slowing in terms of the economy or a potential recession in the next 5 years. which would increase actually the danger for the economy and also the uncertainty for the economy. And this is why this effectively has a more risk now than the 30-year one, which is a longer term. Now, typically that doesn't happen, and you'll see that in the previous years it has been lower, although it was creeping up higher in the previous months and days, that is, actually, in this case. And so this is one of the indicators that can potentially tell you that there may be an upcoming recession, and it's something that we need to keep in mind. This is an important indicator, and it tends to predict recessions at a fairly good pace, especially when we're talking, I believe, about the 2-month and 10-year one. I think this one is the leading indicator for the most part that really tells us, can actually effectively tell us about the recession. But it's again, it's important to take a look at the different times as well, different periods, to see whether there's an inversion. And this actually happened. Again, it's the 5-year and the 30-year that you are looking at here. It's also the 3-year is inverted as well. Okay, let's move on to the next one. Now, not everything is negative, of course, and the US unemployment rate is actually fairly nice over here, and it remains unchanged. It's sitting at 3.6% and going down from previous months. So this is a nice thing to see, actually, because it means that the overall market doesn't have a lot of unemployed people, and so people that are working can definitely help the economy. You don't have a lot of unemployment. It's a good thing about an economy that is growing and doesn't remain stale or actually goes the opposite direction. So this is a very good thing. But there are a few other things to be taken a little bit of a closer look at when we're talking about employment, really. And so I wanted you to take a little bit of a brief look at this article here about the 2007 to 2009 recession, the decline in work hours during the 2007 and 2009 recession. And so work hours is an indicator that is very beneficial to take a look at, because if we're talking about a situation in the economy where we're entering a potential recession, you will likely see less work hours, people pretty much employed less hours, or actually you may be seeing more temporary people than like full-time employees, really. And so this can be an indicator. And so I wanted to examine what is happening with the work hours in terms of the employment in the US. And I have a little table here that shows you the work hours, pretty much split into industries, and also it takes you back to May 2021, March and 2022. April 2022 and May 2022, so that you can actually compare in a little bit of a better manner. And typically you want this to be at a similar level or maybe a little bit higher. And it can be a little bit tough to judge what is actually going on here, because in some situations they may be higher, in some situations they may be lower. But we can actually take a look at another chart which kind of shows us the average here. And so this is an interesting chart here because it shows us the average weekly hours of all employees here. And you will notice that back in the 2008 recession, this actually started to fall apart. As you can understand, it went down and down. And so right now, there was a little bit of a slump back in 2020, as you can understand, where we entered this little bit of a recession phase, or the short one. And then it started creeping up higher. Now, lately, it looks like it's going down a little bit again, on average, pretty much. But not to a point that it seems like it would be a recessionary thing here. So I think that even though there is a little bit of a decrease here, this is and this is something that we would definitely want to be taking a little bit of a closer look at in the upcoming months or so. It looks like it's still relatively fair here. Okay, let's move on to the next one. Now, the gross domestic product is basically, for the most part, how we define a recession. So if we are entering negative growth here, and this happens for 2 quarters, this is generally speaking considered an upcoming recession, or the initiation of a recession, really. And so this is what happened in the previous quarter. You will see here it was 1.5% of a decrease of the annual rate of the GDP growth. That's the gross domestic product for the US. So if that continues happening, this is definitely a recessionary factor here, the fact that the economy pretty much grows in a negative territory. So the next one, inflation. Everybody knows about it. It has been discussed to the core. And as you will see, in the past few months, it has been increasing a lot. And take a look at this here. This has been some massive growth of inflation over here. and it doesn't look like it's getting that much cooler right now. It may continue going upwards for a little while. Now that depends a lot again on what the government does. It's really dependent on the government and the Fed, of course, but for the most part the government. So if the government starts issuing issuing more money to people, like helicopter money, or just locking people down, continuing this kind of ridiculous policies, then we're going to continue having higher inflation, no doubt about it, regardless of what the Fed does. And so this is why we really need to be paying attention on what the policies of the government will be. Okay, now tied to the inflation is the consumer price index, which kind of tells you how fast prices are rising here for a basket of necessary products. And you will see that this kind of growth almost becomes sort of like exits the linear phase, and it becomes exponential almost. So it goes higher and higher. And this is of course what inflation is about. This is what will have to cause an increase in interest rates and kind of spin the wheel towards a potential recession here. So that's interesting taking a look at, and it's always something that you need to be aware of what is going on here in terms of the increase in CPI, which seems to be increasing pretty much consistently, and that's bad to see. Now the next one, consumer confidence, and you may be wondering why does that matter. And it matters a lot actually. It's a very, very important indicator because it tells you about how consumers are thinking about the economy, and based on what they are thinking about the economy, they are acting pretty much on a similar manner. And so you can kind of see where we are. Obviously the higher the better, and overall it looks like it's going down a little bit, as you'll see. And the thing is, you'll see here like the actual is 108.6, forecast was a little bit lower over here, and again actually is a little bit higher than the forecast. So the forecasts supposedly were a little bit lower for the most part than what actually happened, but still we're noticing a little bit of a decline in terms of consumer confidence here, and that's obviously a very, very bad thing. Next up, the yield curve as a leading indicator. And we talked about the yield curve, it was the first thing that I mentioned, but it's interesting to know, if you didn't know about this, that the Federal Reserve Bank of New York actually creates a chart here about the probability of a US recession in the upcoming 12 months, that is. So when you are looking at the single point, it's about the next 12 months really. And so back in 2020, that is over here, let's just say June 2020, there was a 31% case, a 31% probability of an upcoming recession in the next 12 months. That would be till June 2021. So right now this has actually gone down pretty much substantially, currently sitting at 3.7 for the next 12 months, that is again. And so this is based on the yield curve as a leading indicator, and this is why I told you earlier that you can see like just one case of some long-term bonds having a lower interest rate than some of the shorter term ones. But overall it seems like if we're taking a look at the overall yield curve here, it looks like we are not entering a recessionary phase again based on this. This is not the only indicator, but it's an important leading indicator actually, and it's useful to at least know about. It used to be higher than what it is right now, and you can kind of see back, for example, in 2008 over here, 2007, earlier, because again, remember, it's a leading indicator, we were having a 37%, and actually a recession followed right after that. Okay, so let's move on now and take a look at the next one, which is about retail sales. And it's interesting to take a look at retail sales, and you can also take a look at manufacturing, for example. There are a lot of indices, or however you want to call them. And in this video, I'm just mentioning some. You can take a look at a lot more things, really, if you are interested. But you kind of see this going in an upwards momentum here, and this is what is happening lately. And we did have the massive slump back in 2020, which didn't really cause a lengthy inflation, that's a lengthy recession, that's a good thing. But right now it looks like pretty much spending in terms of like retail and all that seems to be just fine still. So that doesn't seem to be a big problem right now in terms of what is happening with the sales. So that's good to see. Now the next one is claims. That's unemployment claims here, and again take a look at 2020. Insane amount of unemployment claims. Again, remember recession, sort of like a recession because of COVID, because of lockdowns for the most part. All of these policies pretty much massive claims here, and this seems to be going down finally, and looking much better now. Okay, so next up, we're going to take a look at a leading indicator that's created by the conference board. It's called the Leading Economic Index, and I just wanted to bring up the Investopedia here page, just so that you can understand what this is about, because it's about a lot of different data points here, like the average weekly hours worked, average number of initial applications for unemployment insurance, kind of things that we talked about, volume of new orders for capital goods, number of building permits, a lot of stuff here, the S&P 500, the index, a lot of stuff are actually equated together and are giving us a leading indicator, and it's important because it is, again, a leading indicator. A lot of the indicators are actually lagging indicators, so they happen after the fact, after the recession. But over here, we can kind of see this one as a leading indicator, because you can see that it was actually going down before recession hit. You can see the recession time in this darkened area here, and this actually predicted recession as it was going down, but of course not always, right? Like in this situation it didn't happen, but it was close, and then it was a little bit of a sort of like dead cat bounce here, and then we had the full-blown recession. But in many situations, as you'll see, a leading indicator initially predicting that we are kind of going down. So as this is trending down, again over here, you'll see 2008, it was trending down for a long while over here. You will see that right now we are in a little bit of a steady phase and even going upwards over here. So it seems to be having an upwards momentum after, pretty much entering 2020 over here, which was an upwards momentum till February 2020. As for the leading index back then. And so you can see what is actually happening right now. You can see the leading economic index for the last few months over here, which has been increasing overall, although it has been steadier and a little bit down over here, as you'll see in that was March, sorry, apologies. And April 2022, it actually crept up a little bit higher as well. So there seems to be a little bit of a steady case here. It doesn't seem to be going down, but it's still steady, it looks like. So this is for the most part what I wanted to talk about in terms of some indicators about what is happening and whether there could be a potential recession. Kind of wanted to bring on some data and actually talk about it. It seems like some data point to a potential recession, but overall it doesn't look like the economic indicators, or at least a lot of those indicators, agree with a potential like full-blown recession. It mostly seems like this may be a little bit of a transitionary phase, which can have a little bit, of course, of a downturn, and it already had, especially for the markets. But in terms of the economic indicators, unless things get worse, they don't look that terrible yet. So, of course, you can pick and choose and find different ones that will be worse than the others. Of course, energy prices and all that. The inflationary environment, all these things can be a burden and eventually lead to recession for sure, because these indicators can tell you a few things, but what happens again with some of the financial aspects, some of the political aspects, especially that, can actually turn for the bad or for the worse or the better, really. And so it really depends on what is going to happen there. Again, politics are going to play a massive role on whether we're going to enter an actual recession, or we're just going to be having a long bearish market, sort of, in terms of the stock market, maybe, and then kind of go back to normalcy. Thanks for watching the video. Let me know what you think about these current times and whether you are thinking that a recession is upcoming. And I'd love to hear your opinions. Leave a comment below. And I want to thank you for watching this one. Please remember to leave a like and subscribe if you're not a subscriber already. And I'll see you in the next video, guys. Bye bye.